And then this fourth step is invest the money in the stock market. Now, this is where, Matt, I wrote recently about some changes I've made, but the default option I've been using for decades for each of my three daughters now in their 20s, entering the working world, for my sister, my parents, is have the money go into the money that's withdrawn from your paycheck goes directly into a retirement account at a Vanguard or Fidelity or something like that, and then is automatically invested into the S&P 500 index fund. Super low cost. And the S&P 500 index has outperformed, depending on what time period you look at, 80+% of actively managed funds. And that has resulted in very, very nice nest eggs for, my sister, my parents, starting to build for my daughters. The S&P 500 has been a fabulous investment, but the key is don't look at it. Don't get freaked out by, the stocks market falls 20% in April, and you get scared out at the bottom. Maybe look at it once a year, because effectively what you're doing is you're dollar cost averaging over a long period of time into 500 big U.S. companies, basically into the U.S. economy, U.S. stock market. But the key is don't try and time it or do anything. Have it just be automatically set up. That's sort of the base advice. And then, if you want, I can sort of talk about how I've sort of tweaked that advice just in the past week in my own account.